Hey everyone, so I wanted to make a quick video on POI selection. I get these messages all the time, not just from our members, but a lot of Instagram people and Telegram people that follow me. And everyone's always wondering, how do we choose the perfect POI? Is there any secret to it? And the honest to God truth is, we do have certain things that give us stronger POI criteria, such as, is it a flip zone? Did it take liquidity? Is inducement intact? Is it properly priced? Did it create new structure? Did it cause a new high? So just for example, on the market outlook this Sunday, I was talking about this zone being a strong weekly zone. And the reason I use that as a strong demand zone is because we took this high and made new weekly bullish structure. So this zone to me had some sort of strength. On the flip side of things, this zone to me is also strong because we got a lot of inducement intact and nothing's ever really really come back and mitigated. So there's a couple things I want to go over from different time frames and different perspectives, and just kind of show you what I look for in POIs. And no matter how much you dissect a POI, there will never be a perfect scenario that works 100% of the time. What I can say though is POIs that cause lower prices do usually get mitigated. So let's just jump into the daily side of things. Then we're going to jump into 4-hour side of things. And then we're going to look at 15 to 30 and even 10 minute to 30. And I just want to show the different things I look at on different time frames, and hopefully it helps some of you guys. So let's just begin with the daily. So we have a daily flip zone here. Something I want you to notice is this low was taken, a new daily low was created, this high caused it. You have inducements sitting here. Yes, you made lower prices there, so at the time you might have even been able to take a day trade off of here. That obviously didn't go far, but you can see you had a small reaction. But we're going to dissect all of these and just look at what zones react and why. So I'm just going to pull a few zones. So we're going to call this one a daily supply. We're going to call this a daily demand. And whatever breaks the extremes, a lot of times it is a good place to look for a POI. And you'll see this repeat over and over. But if your POI doesn't get hit, don't sit there and be like, this is my only POI. It didn't get hit. You have to trade what you see. What I teach you does work, but this is a market full of probabilities. Probabilities meaning that these are good zones, this usually works, but it's not always gonna work. So we're gonna just mark a few more zones, and then we're just gonna talk about what reacted where, and then we're gonna delete all of these, and we're gonna do this again on the 4-hour and the 15, and with a little bit of luck, some of you guys will be able to make sense of it. So this concept will be a little bit easier for some people than others, and ultimately you're just gonna have to get on the charts and physically pull these zones. And the idea is, the first thing we want to look for is zones that cause swing points to fail, whether they're large swing points or mini swing points. This was a low at the time. This high took this low, so that makes this high really strong. If we really break this down, this demand had a reaction point right there. And if we really want to get technical, these sell to buy wicks here actually took the reaction point out. Now what these sell to buy wicks are in here is a zone that is a little more in tune with the recent exchange where money exchange hands. Obviously, you created some sort of inducement here. You did come back and mitigate that one more time. The flip side of things is if that zone here failed, this supply here, we would be looking at the extreme here, because it's always one of two things. It's what took out the reaction point. 3 out of 5 times that'll be a good zone. The other 2 out of 5 times it is the extreme. But back to our sell to buy wicks. I know some of our members had questions about them. What these sell to buy wicks are is it'll likely be something on a lower time frame. So if let's just see if it's something on the 4 hour. So our sell to buy wicks are right here. My daily order blocks didn't switch over to the 4 hour. They only show up on the daily to help me clean my charts up a bit. But what we can see here is the same reaction point we were talking about. And from this reaction point, we had a zone that took it out. So if you really wanted to get technical, this is your actual supply that actually caused the failure. And I believe this one should show up on the daily. We tapped into our inducement. And the market's fractal. This will happen on every time frame. But usually if you can notice something on the daily or the 4 hour, it's a safe bet to go investigate this stuff. So again, we had a flip zone here. If you count all these wicks, there's a reaction point. What took out the reaction point? The initial thing that you might have even gone with was this, which is totally fine. You would have got a day trade for that day. Sometimes the market revisits the area to grab more liquidity, and that's just the way she goes. But again, this is your most relevant zone. If you really want to get technical though, it's from up here to up here is your zone. Because just because we see this on the 4 hour doesn't mean the market's not going to react to the 8 hour. So this is where we pull these POIs and you'd look for something on the 15-minute for an entry there. Once again, you had a demand here. Something in here caused it to fail. You could say, no, you didn't really have a reaction there. It kind of just went through. So this one would go to the extreme. But again, you would have another day trade. And the idea is the first thing we want to locate is these flip zones. I'm going to just go back to the daily here. And with a little bit of luck, all that stuff shows up here on our daily chart. I believe it did. Yeah, it did. So, okay. So, what we were talking about earlier, if you see this 4 hour supply is a little hard to spotting here, but you can see this 4 hour supply was found in the sell to buy wicks. So these sell to buy wicks are always a valid point to look for a trade if there was some sort of reaction caused by them. At least it's something for me to go investigate. But so that's the starting point for our POI selection. Did it cause a flip zone? Is the inducement intact? If the inducement's intact, where is it? Did the market really come back and mitigate that area? And in a perfect scenario, we always like our good little friend, the fib. Let's actually use a cleaner one here. We always like 50% of the fib mitigated. But if we're going to be realistic, it's probably something closer to our other fib, which is not that one. I have so many of these fibs. Gets confusing. Maybe it's that one. So yeah, that's the more realistic fib. We like to see the 50% mitigated, but sometimes it is just this zone. And this is considered relative equilibrium. So in the perfect world, we like to see relative equilibrium get tapped. No, it doesn't always happen, but it's a sense of structure for us to look at. For anyone that's wondering what the levels of that fib are, that's it. The most important levels are the 0.4, 0.5, and the 0.6. Everything else just means you're getting a really good deal for your buys down here, and you're getting a really good deal for your sells in here. But as long as we're in that premium, we could sell. As long as we're in that discount, we can buy. With this being said, if the market's showing that demands are holding the whole way, there will be times where you end up buying in premium. And again, that just goes back to nothing's perfect. You have to trade what you see. But back to our POI selection here. Just the way we're looking at this, again, if we find these reaction points and what took them out, more often than not, these zones do get tapped. And this is on every time frame, not just the daily. So we'll call that the, what is it? Daily supply. And you can see again, you have your sort of inducement down here. And you could even say you stacked a bunch of more liquidity for the taking here. And these are relative equal highs, and a lot of times they'll be used to induce the market to go the other way as well. That's probably more liquidity. The first one would be more inducement as it's closer to the OB. But as we can see that a lot of times these flip zones do get mitigated. Does it happen every time? No. But these can be the ground for us starting to look for these POIs. So this is the daily time frame. Obviously, very big time frame. You would find the market does the same on the weekly and the monthly. No, you don't need the weekly and the monthly to trade our system. You'll most likely be using the 4 hour, and with the 4 hour, you're going to find a little more clarity in POI selection and whatnot. And at times, the market's just going to do what it's going to do, and there's nothing you can do about it. So here's a prime example. So we had a last sort of 4 hour demand. To me, the sell to buy wicks would have been a great supply to get in. However, we have to adapt when the market doesn't show us, doesn't give us this supply tap. So what I mean by adapt is, did the market liquidate? Yeah, we did. We came above this here. We took this liquidity. If I went down to the 1 hour, the 45 minute, there's guaranteed a supply of some sort in there. We definitely tapped something. Let's see. Since we're there, let's actually just check the 1 hour. So on the 1 hour, not so much the 1 hour. I guarantee you there's something there on some time frame. Somewhere. There it is, actually. It's our breaker block that ended up holding. We did end up closing above it here, which might have given some of us the idea that we should start buying, but you're going to go back to it is bearish here. And ultimately, what you would start looking at is, okay, my POI didn't get tapped here. This breaker's clearly holding. And at this point, I would start looking at basing trades off here. We liquidated here. The next thing you have is this is your 4 hour low here. The next thing you have here, let's see, let's go back, whoops. Let's actually go back to the 4 hours. So that's our low there. So let's just investigate that. So you have one of two things here. If this is our low, again, we have a 4 hour demand. Where's the reaction point? This is our reaction point. Where did the move come from that took out that reaction point? Well, now we're back to this 4 hour POI. Where's your inducement? Right here. That's intact. And a lot of times these things will align for us, and a lot of times the 4 hour, like right here, the 4 hour didn't play for us. So how do you know whether you should wait for this or not? the true answer is you have to react to what the market shows you. So when this low went, that right there made this a strong high, made this a weak low. Our expectation is to run that low. And you guys can test this, like I said, any time frame, 1 hour, 8 hour, daily, weekly. It doesn't matter. For the most part, these flip zones are really strong zones. Now, this POI selection thing gets a little trickier when we get into intraday. And there's a couple of reasons for that. One is the 15-minute can be very noisy. So this was yesterday's daily POI. And everybody was messaging me, members and non-members, asking why we tanked like that. So let's look at the reality of it here. This isn't like a great demand, but it's some sort of demand on some time frame. Not so much on the daily, but it's definitely a demand on something. And I'm personally not a big fan of demands that don't create new highs, but however, I still have to talk about them being broken and what caused the break. So what caused that demand to fail? This did here. Now, let's go down to the 4 hour time frame here. And what do you notice here? So this was our weekly zone tap on euro here. We obviously expected a good retracement. Sell side or buy side liquidity, buy side liquidity. The market's still bullish on the 4 hour. Did we expect this daily high to get run? Possibly, yeah. There's liquidity up here, but not like run as in a daily close. I expected it to maybe grab that liquidity and do something. Now, it's a little hard to see on the 4 hour, but on the 15-minute side of things, if we actually look what happened here, you have all this buy side liquidity here that's untapped. There's some more here. Alternatively, this is the zone that caused the impulse down and this demand to fail, inducement. So you pretty much filled your whole bowl, grabbed all your internal range liquidity. Here we tapped into our external range. This is where I was looking for sells. Unfortunately, my criteria didn't get met, so I didn't catch any of that move. But that is how I break down POIs. I start on the daily, I go down to the 4 hour, and if the 4 hour is unclear, you could start going down to, the 2 hour, the 1 hour, and wherever you see things that make sense to you, I'll start marking stuff out. So I know in the 4 hour there was something here. On the 4 hour it was hard to spot. On the 1 hour you can see it. Half hour you'll probably see it better. So these are the easy POIs to spot because I think anybody can mark 4 hour daily because of how large they are. So where it gets a little bit trickier is the 15-minute side of things. And this is where you can have multiple POIs and you don't know what to do with it sometimes. So I believe this was last week. So same thing here. We had a sort of a supply zone here. 15 supply. Let's actually go to 15. So on the intraday side of things, right away, the first thing you want to say is this is the zone that caused to fail it, which is 100% true. You're not wrong. You have to start looking at where are the flat spots in the market? Where is the money lying? Well, this could be a sort of inducement here. And if we look at the pricing side of things, now I don't need to pull a fib on that to tell you that you'll likely see something a little bit lower than this. If we use this zone as the cause of the failure, you're very high in this leg. There's a good chance you're going to come down closer to equilibrium. Not always, but there's a good chance. So what I like to find is equilibrium and look at where if there's any inducement around there. And then you could start pulling POIs. And ultimately, you have a zone here with a bunch of trend line liquidity. So this becomes a valid zone to me because we can use this as fuel to rocket on up. This zone here also becomes completely valid to me. And we don't always know which zone's going to go, but these can definitely help us narrow in which zones are stronger. So inducement being one of the tools you can use. What caused the flip? The next tool you can use. So again, you have a sort of a supply here, and these wicks, they are a supply. Just because you can't see it on the 15-minute doesn't mean that this zone's not a supply. Like, I always pull POIs like this, and obviously we'll have the extreme, because I don't know that it's not going to react off this then go up. People ask me, how do I know which zone's going to react, which zone is likely going to give me the trade? And what I do is I find high probability zones with liquidity intact, and something that did something, caused higher prices, something that's priced properly. So these two zones stood up to me, and obviously we have this, and obviously we have this wick, and preferably we don't want to see price go down to the extreme after it took a supply, because this did create new bullish structure on the 15 at the time. I believe, yes, it did. Again, so moving forward now, what caused this reaction point to fail? Well, you have two possible zones. Scenario one, you have this zone, which I like, which we definitely like. And scenario two is the sell to buy wicks right above it. Now, what a lot of times what sell to buy wicks will do, and not always, but the same as a breaker block, a lot of times it'll do something like this and then go up and use that as inducement and then continue up. In this case, the sell to buy wicks held, and one of the things we can look at for giving it strength to hold is, did this POI give us higher prices? Well, it did. So this is your low point, this is your high point. You took this high, you create a new bullish structure. Ultimately, this is the flip zone. This is the extreme. So either one of those is valid. So this is a strong sell to buy wick area. And if you went down on the 10-minute, 12-minute, somewhere in there, there would likely be a doji or something in there. But that's not really the most important part. The most important part is that we have all this untapped inducement, and that can be used as fuel. Now, on the flip side of things, the question is that inducement? It absolutely is. The thing you have to remember is you can mark all the liquidity in the market. We don't know when the market's going to come get all of it. But if it grabs some of it and we see something that says maybe there is a trade going the other direction, that maybe we can frame a trade ID off of it. So again, we have a supply zone here. And if we look at this, I'm just going to retract that. I'm just going to call that supply. Okay, so again, you have a couple of POIs that we really like, and we're going to retract these to clean it up a bit. You also have the extreme supply, but I want to know where the initial flip happened. So the initial flip was this supply that needed to go for me. And the reason that supply needs to go for me is this supply here caused a little bit of a flip when it caused this demand to fail. So now when this supply fails again, it's telling us that maybe demand's back in control. And ultimately the market's always flipping, and we're trying to get in on the right side of these flips. So again, where's the reaction point? If I investigate something on the lower time frame, let's see if we can find that on the 10-minute here. So you can't even see it on the 10-minute. It's like we have 5-minute or a 3-minute reaction or something. You don't need to go down that low, but so there's your actual reaction point right there. And I call that the reaction point because the there was some sort of a battle between supply and demand here. I don't need to go down to the 5-minute to find it. I can see it there just because it's a wick. Only BFIs create wicks. If it's a wick on anything from 10 to 30 minute, that's good enough for me. I don't really go below 10 minute at all. So this wick now becomes a valid demand zone. So we did push up. This high was taken here, and you once again have two areas. And we also, I believe I reviewed this a little bit and showed you guys an infographic version of this. But the idea here is looking at the speed the market's going up versus it's going down. So this whole time we're stacking trendline liquidity. So at some point you do expect this to fail. But as long as demands are holding, you continue on buying. So again, you have two valid POIs here. You have POI 1 and you have POI 2. I would take trades off any. So these sell to buy wicks, they're holding. Like, yes, you could say you were reaching below. Is that a chalk? No, for me a chalk. I want to see the actual candle bodies. I don't consider sell to buy wicks as chalks. I want to see the actual 15 logo. So this would have to do something like this and then go down. But one of the questions I get asked a lot, is this a disrespect of a zone? It is. It absolutely is. But there's no candle body close. So this is where you have to be like the 15's a confirmed bullish trend. So as of right now, I'm going to buy off this. If this low goes and it fails, I'm going to get back in here and continue on up. And that's kind of the way to look at that. So now if we look at these sell to buy wicks, they hold once and you have a bit of a flip zone once again. And this is your flip zone here. Now, if you really investigate here, your reaction point's actually down here, because the initial supply that you're actually looking for is lower. And this is why I tell people to trade one pair, maybe two max, because this is a lot of details to notice. So this little doji area, kinda, all these little wicks, that's actually a bit of a supply area. If you really want to get technical, that's the supply. You're looking at breaking, reaction point. And what caused that reaction point to fail? Well, you would say likely this wick, which does get tapped, or the whole black candle, however you want to pull it. Which also happens to be the sell to buy wicks holding, but nonetheless, the concept is the same. You have inducement intact. We came and tapped into it, and we have another flip zone here. Reaction point, what took out the reaction point, and you would likely say something in this range did. In this case, it is this big ugly candle. When we see these big ugly candles, if the wicks are bigger than the bodies, I really like that. More often than not, it will tap deeper into the wick. In this particular example, didn't, and that just goes back to saying nothing's 100% perfect. But if you went down on lower time frames, there would likely be chalk and flips in some of these zones. No, not every one of them is going to give you a perfect trade. But this is some of the ways I pick POIs. Like, I don't just come and start pulling this zone and this zone and that zone and this zone. I just look at it logically. Where's the liquidity? You have trend line, you have flat spots. Where's the liquidity? Flat spot, and ultimately liquidity. That wick takes it. You have liquidity here. If you actually look real close, this wick liquidates before it takes off. And we always want to see some sort of liquidation before we leave the area. So again, liquidation and then impulse to the other side. Liquidation, impulse to the other side. Liquidation, impulse to the other side. And anytime we can see even the tiniest bit of liquidation, it can give us confluence to trade away from it. As far as I know, some of you guys were looking for how do I pick a POI that never fails, that's perfect 100% of the time, is kind of some of the questions I got in the DMs. It's not a thing. There are higher probability setups and higher probability demands and supplies, but as far as me giving you two sentences of what works all the time, there's nothing like that. I can tell you what's higher probability. So right here again, liquidation, and we go up. Even when this started failing here, you did have a little bit of liquidation from these wicks. Again here, liquidation, and we like to see that liquidation and trade away from it. Sometimes this liquidation is so small, it's just like what I showed you guys here. This is all that can be considered liquidation. Like, the market doesn't have to come down here and liquidate all of that to move up. You guys have to remember, this is Euro USD. Some of these candles are probably billion-dollar candles. That's what it costs to create one of these. A lot of days, Euro is $1 trillion or more a day goes through it. So if you calculate Euro's ADR 68 pips a day, you can imagine the cost of creating some of these candles and wicks. It takes billions to do that. So if they come wipe a little area like that, we have no idea how much money's sitting there. You know, hundreds of millions, billions. Like, this is, on a pair like Euro, there will be a lot of money. And I don't know the exact numbers. I'm just going off the fact that it's $1 trillion a day or more this pair has to go through it. So, like I said, if you really wanted to, you could calculate how many pips it moves in a day at 68 pips a day. Each pip is roughly so much. But without dragging this on too much further, we're always looking to liquidate. And anytime there's a liquidation of any sort, we ultimately look to trade away from it. And on the flip side of things, when you're taking these up, I'm always looking at running the week high. Don't ever shoot for the stars without paying yourself. So anytime you run a high, you pay yourself. You run a high, you pay yourself. You run this high, you pay yourself. You run this high, you pay yourself. And as long as you do that, you're always taking something off the market. On the flip side of things, which of these zones are strong? Well, any of these zones that put in lower prices, you're going to see some sort of reaction off it. You'd be silly to think that there's going to be nothing there. So, yeah, you can go through these zones, and sometimes the market does do something like this where it goes right through it. But more often than not, you'll expect a reaction. And the reason I say this is if you're in this part of the leg, you haven't tapped this supply yet, don't be looking for buys up here. Take your buys down here so that you can be break even and partials off the table before this even gets there. So you're always looking for that 5R run minimum to get involved. And a lot of times I'll stay out of the 4Rs and the 3Rs. If there isn't enough distance between me and the higher time frame supply to at least break even, I don't want to get involved. And I know some of the trades I've gotten sent to me in the DMs, there's people buying in here, and I'm not saying it won't work for you. There will be times where it will, but more often than not, you want to be able to go up and break even. If you were in a bearish market, you'd want that travel room to go down and break even and maybe take little partials. If you don't have that, don't take a trade from there. So, for example, once this supply goes, your next one's up here, but if you get in down here on the lower time frame, you would be able to at least get your risk off the table in case this turns around. Without dragging this on too much further though, this is what I look for in POIs, guys. Anytime there is a flip, there's what took out the reaction point, there's the extreme. Ideally, I like to see what took out the reaction point, give us the POI I want. It doesn't always play out. And the other thing to remember is there's always shit in wicks. If you see a long wick, there's something there. Don't ignore it. And that's on any time frame. And if you really want to get technical, investigate these wicks on lower time frames and you can find something and you can pinpoint exactly where to get in. For example, if I have a 1 minute POI that's 5 pips on Euro, I might go down to the 30-second and find out that the money exchange hands at the bottom half and only put the order in on the bottom half. Sometimes it helps. The market's the exact same with the larger time frames. You'll be able to investigate on the lower time frames and find exactly where the money exchange hands. This isn't a picture perfect system, but it can help to improve your odds where you find where the money exchange hands and the market flipped again. Because ultimately you're always flipping down or flipping up. Either demand's in control or supply's in control. But yeah, I'll end this video here, and I hope this helps some of you guys out with the POI selection side of things. And yeah, I'll see you guys on the Zoom shortly here.